Hey, good morning once again, options traders. Well, about a week ago, I received an email from one of our traders, and he was claiming that he had this system and that his system was working, and he had this way to kind of beat the market. And his claim was that he had 60% or so winners. And in a way, he was challenging or questioning some of the videos that I've posted in the past talking about random walks and why they're so hard to really even detect and how we can be fooled by the appearance of random streaks. And so this is the approach that I took when answering his email. He had a handful of winners. It might have been 10 or 15, 20. But the question was, let's assume that we have two coins, one that comes up heads 50% of the time and another that comes up heads 60% of the time. And the question is, can you detect the 60% coin versus the 50% coin? Now, of course, anybody who has had basic statistics will say, well, of course you can. It's just a question of how long you have to do this test before you can detect it. And that's really what we want to address in this video. How long would you have to flip this coin before you could detect a 60% coin versus a 50% coin? Well, the answer is it's longer than you think. Let's go find out how long. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start off with a random walk. Remember that with a random walk, we're going to assume that we have a 50% chance of up or down. So it's a real easy model or example to use a coin flip. 50% of the time we're going to see heads, 50% of the time tails, and overall we should just go sideways. So therefore, sometimes you end up with gains, other times with losses. But again, overall, it's a sideways motion. But now let's assume we have two coins. Coin A, we'll call it, comes up heads 50% of the time, and coin B comes up heads 60% of the time. And so again, the question is, how many flips would you need before you could detect which coin is biased? How many times would you have to flip before you could say, I know that coin B is the biased coin? Now, again, a lot of people would say, oh, with that big of an edge, wouldn't take long at all. 10 or 20 flips, and you could easily figure out which one is the biased coin. And that's where the misperception lies. How many flips would it take? Well, let's go to an Excel spreadsheet and look at the details. Now we're into our Excel spreadsheet, and column C over here is just counting up to 300. We have 300 rows, actually 301, counting with 0 here, but it's going to give us 300 attempts. And coin number 1 is our 60% coin, is our bias coin, and coin number 2 is our, what we might call a fairly valued coin. It comes up heads and tails 50% of the time. So what we're going to look at is we're going to assume that we're flipping both coins, and we're going to win $1 if it comes up heads. We're going to lose $1 if it comes up tails. So obviously you should be on a net winning streak with this 60% coin. And with the fairly valued coin, you should just be going sideways. Then in column F right here, we're going to take the net gain or losses for coin 1. That's our bias coin. And then column G here, this final column, is going to do the same for coin 2. So in other words, let's say after the first 3 flips, we won $1, won $1, and then lost $1. So that would be overall up $1, and that's what that number is showing right there. For the fairly valued coin, we won $1, won $1, won $1, and we were up $3. So it's just keeping the net gains or losses here for both coins. Okay, so this blue line is tracking the gains or losses for the bias coin, and the red line is tracking the gains or losses for the fairly valued coin. So you would expect that the blue line should, certainly in the long run, sit above the red line. But what we're interested in is look how long it takes before that separation occurs. So you can see that down here in the first 50 flips, it was really hard to tell. In fact, the unbiased coin was actually in the lead part of the time. All right, so let's do another simulation of 300 flips. Now we get a similar pattern. In the long run, we can see after roughly 100 flips that we see a clear winner right here. This is our biased coin in blue. Here's the unbiased in red. But look at how in the short run, kind of hard to detect. In fact, in many of the places here, the red line actually sat above the blue line. That means our unbiased coin was actually beating the biased coin. And that kind of surprises a lot of people. They say, well, how can that be? This is part of the point of a random walk. Even with a 60% edge, it can be hard to detect. Let's try a couple more. Okay, here's another one. Take a look at this. The fairly valued coin, the unbiased one in red, actually won here in the short run for about the first 50 flips, then fell behind. So you might think, it's really obvious now that the blue line is our biased coin. But look at this. Come back from behind. And the unbiased coin actually goes out in the lead. Even though the other coin is coming up head 60% of the time, the 50% coin is winning. But then it looks like after about 200 flips that we start maybe seeing a separation. Now there's no question that if we extended this graph further out, let's say 500 or 1,000 flips, you would absolutely see the blue line sitting above the red line. The reason I didn't want to make the graph that wide is I wanted you to see, really for these first couple of 100 flips, that it can be really hard to detect. So the question is, how many flips would you need before you could say with 95% confidence that you are looking at the biased coin? And in trading terms, you're just saying, well, how many trades would I need to maybe give me some supporting evidence that I'm on some kind of a winning streak? Well, for that, let's go over to another page here in our Excel sheet. So over on this page, and I'm not going to bore you with the details, but if you've had basic stats, you would know how to do a difference in means for, let's say, for a coin flip is what this really comes down to. So we're assuming that we have a 60% coin and a 50% coin. And right now I'm going to assume we're going to flip each of them 50 times. Now there's a number of ways that you could come up to this calculation, and each one can actually come up to a little different answer depending on assumptions. So I'm just going to use one where we're going to do what's called a pooled mean. We're just going to combine these. So what this means is that if you had a 60% chance of coming up heads and you did that 50 times, you would expect to get 30 heads. That's where that 30 is coming from. If we did it with a fair coin at 50%, you flipped it 50 times, you would expect to get half heads, half tails, 25. That's where that's coming from. So we flipped each of these 50 times. So if we add them up across, we would have 55 would be the expected number of heads out of 100 flips, or 55%. So we call that the pooled mean. It's just saying the halfway point between 50 and 60%. And then we're going to do a similar style of calculation with the standard deviation, and we're going to come up with 0.0995, roughly 0.10. And so now we can say we're trying to test that the difference in these means or these averages is 0.10. We're going to say how far is that off of 0 relative to the standard deviation. So it's taking 0.10 divided by this number. And then we're just going to compare that to a bell curve. And a lot of basic statistics, especially for social sciences, would usually use 5% as a cutoff point, and saying that if we can get this to within 5%, meaning that our little experiment here would only occur 5% by chance, then that's probably good enough to say that we're on to something, that we are actually detecting a difference. So with 50 flips on each coin, look at this down here. That would occur, this difference of 0.10 would occur about 31.5% of the time just by dumb luck. So you can't use 50 to detect it. What about 100? Let's try 100 here. And so now we're down to about 15.5, 16% of the time it would happen by just dumb luck. Still not good enough. That would be very hard to say with certainty that this coin is the one that comes up 60% of the time, because 15% of the time it's going to be by dumb luck that one coin will beat the other. So let's go up to maybe 150 flips. Probably a lot more than you thought. Now we're down to 8%. Still not good enough. Let's try 200. Okay, see, now we finally dipped below 5%. And again, that's a typical cutoff. And of course, the more confidence you want, the more rigid you would make this cutoff. You would want this number to be lower, so maybe 2%. But what this is saying is that we have detected that, let's say this is our bias coin, we would be right 95% of the time. Only 5% of the time, we would say this is the bias coin and we would be wrong. So that's still a pretty good cutoff point. We're going to be correct 95% of the time. So in statistics, we would say that we are 95% confident that we have found the bias coin. Now, I've gone through and actually worked this backwards, and it came up to be 192. So watch what happens if we go to 190. See, we're at 5.01. We're not quite to 5%. We're close, but if we go to 192, we actually dip just below 5%. So using this method to test these two coins, we would need 192 flips before we could say that we're 95% sure that we have found the bias coin. So same idea in trading. Just because you've got 5 trades or 10 trades that you're winning 60% of them, that does not in any way remotely show that you have a system that is better than chance. So just remember, a 60% chance of winning sounds like a big edge. And it is to some degree, but it takes a long time before you can say with a high degree of certainty that it's true. It's not as easy to detect as you may think. So remember, just because you have a handful of trades showing that you're winning 60% of the time doesn't mean you have found an edge, at least anything that you can depend on, because you might be in a 50% random walk and just can't tell the difference. So what's the better approach? Trade the market, but hedge your opinion. And to do that, you need to understand how to hedge, roll, and morph with options. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.